Thank you for participating in this pre-recorded Federal New Market Tax Credit webinar, which is being provided by Community Reinvestment Associates. We are providing this webinar in two parts, and this is part one entitled The Basics. Part two is entitled Steps in Structuring. Each part is approximately 45 minutes long. On our website, we also have a 20-minute webinar that provides more of a big picture overview of the New Market Tax Credit Program for those who want an initial understanding of the program. For purposes of taking notes, you may want to download the PDF located in the purple tab, which is located under the orange tab on our website that links to this part one of our webinar. This PDF is a copy of the slides used in this part one. If you are viewing this webinar on YouTube or another website, our website address is set forth at the bottom left side of this presentation. If you have any problems printing the PDF, please contact us and we will promptly email a copy to you. Before we proceed, we would like to provide a brief introduction to our firm, Community Reinvestment Associates, and how we assist our borrower clients. We are a national financial consulting firm that bridges the financing gaps related to financing real estate and equipment and business and nonprofit operations. We have represented small, medium, and large-sized borrowers in connection with closing over approximately $1.6 billion of new market tax credit financings over the past 20 years since the inception of the program. Borrowers apply to investors and those who have received new market tax credit allocation authority awards, which are known as Allocatees. Borrower applications must be persuasive, well-written, and provide significant details supporting the direct and indirect community and economic impacts to residents in economically distressed communities and to other targeted populations. Proactivity in completing these applications and strategic timing in submitting these applications is critical. With respect to new market tax credit financing applications filed on behalf of our clients, we serve as a gateway of credibility. This is because we sign off on all of the legal, underwriting, tax, and structuring requirements as being satisfied based on our 25 years of finance, legal, accounting, tax, and community and economic development experience, as well as our relationships with new market tax credit financing participants. We quarterback each new market tax credit financing from start to finish, and our fees are contingent upon our securing such financing on behalf of our clients. In this part one, we are going to discuss each of the following topics. This outline generally follows what is on our website. However, we are providing a more detailed discussion and context, as well as additional topics in order to provide a more detailed description and understanding of the program. Please note that upon a request, we also provide new market tax credit webinars targeted towards specific industries and specific borrowers. These webinars can be interactive, during which participants can ask questions. We also provide these webinars at no charge. For this part one, first we will discuss the intent of the program, the four fundamental new market tax credit participants, the economic benefits to the borrower of new market tax credit financing, then who and what are good borrower and project candidates, the permitted and prohibited uses of new market tax credit financing. We will also discuss how the financing is facilitated by so-called Allocatees and CDEs. We will discuss each of the legal requirements and briefly discuss the recapture of the tax credits if there is a recapture event, as well as the unique underwriting requirements of this financing. We will then briefly discuss the sizing of new market tax credit financing. However, part two of our webinar provides more details on the sizing and structuring of these financings. And finally, we will discuss our services to secure new market tax credit financing on behalf of our clients. Part two of our webinar generally relates to the sizing of new market tax credit financing, the steps to apply for new market tax credit financing, and the structuring of new market tax credit financings. The intent of the program is to provide investment capital to low-income communities which have traditionally lacked access to financing. The program is not intended to provide better financing to those who have obtained or can obtain financing, but rather it is intended to provide financing for any shortfall in available financing. The program particularly focuses on the benefits to the residents in such low-income communities and targeted populations, such as low-income persons, minorities, women, veterans, and other populations who have traditionally lacked access to quality jobs and community and consumer goods and services. New market tax credits are equal to 39% of the new market tax credit financing, which is known as a qualified equity investment, which we will discuss in part 2 of our webinar. The program subsidy is provided by an investor's effective purchase price for the tax credits. The Community Development Financial Institutions Fund, which is a division of the U.S. Treasury Department and known as the CDFI Fund, administers the program. Borrowers do not apply to the CDFI Fund for new market tax credit financing, but rather they apply to those who have received non-monetary new market tax credit allocation authority awards from the CDFI Fund, and these are known as Allocatees. There are generally 4 fundamental participants in a new market tax credit financing. First, an allocatee, which has received a non-monetary allocation authority award from the CDFI Fund. That then permits the allocatee to designate a financing or qualified equity investment as being entitled to new market tax credits. An affiliate of the allocatee, which is a qualified community development entity and known as a CDE, and it is organized to facilitate each new market tax credit financing to specific borrowers. Third, an investor, which effectively purchases the tax credits, and its purchase price provides the new market tax credit program subsidy to the borrower. And fourth, one or more so-called leverage lenders, which we will discuss in part 2 of our webinar. Leverage lenders include the borrower's other sources of financing and is used to provide one or more leverage loans, which are run through the IRS-approved leverage structure, which generates the new market tax credit program subsidy. Generally, with respect to the forgiven loan, it only requires approximate 1 to 1.2% interest-only payments during the 7-year compliance period, and it is forgiven at the end of the compliance period. However, it is important to note that a few allocatees require a small portion of the forgiven loan to be repaid after the 7-year compliance period. As we will discuss, an allocatee does not use any of its own funds to provide the new market tax credit financing, and instead it's the investor's purchase price of the tax credits that is providing the subsidy. However, the allocatee is permitted to require this payback because it is facilitating the new market tax credit financing. These few allocatees use this payback at the end of the compliance period to redeploy to another low-income community to further their purpose of providing capital to low-income communities. Therefore, it is important that borrowers generate as much interest among allocatees as possible in order to ensure that an allocatee provides a commitment letter to the borrower that 100% of the forgiven loan will be forgiven at the end of the 7-year compliance period. Second, generally, with respect to the non-forgiven loan, it only requires below market interest only payments during the compliance period. And though the rate is not as low as that of the forgiven loan, it is still a below market rate of interest. And after the 7-year compliance period, it begins to amortize up to 40 years, which can be well beyond the useful life of any secured asset. Nevertheless, after the compliance period, the borrower is permitted to prepay or refinance all or a portion of this non-forgiven loan. Generally, the benefits of the program, whether in the form of the forgiven loan or the non-forgiven loan, include gap financing, as we previously discussed. The program is intended to provide the final piece of financing required. Also, as previously discussed, below market interest only payments during the 7-year compliance period. Each loan is generally subordinated to the borrower's existing and subsequent creditors. Additionally, there are flexible underwriting criteria, such as not requiring a significant prior business history, permitting higher loan to values, which can be far in excess of 100%, not requiring appraisals on collateral, allowing non-traditional collateral such as inventory, limiting the amount of personal guarantees or scenarios for which they are applicable or eliminating them altogether, lower debt service coverage ratio requirements, and minimum equity requirements, which are generally only 3% to 5% and are only required to support a certain tax opinion at closing. However, this equity can often be withdrawn soon after the closing. One of the most significant benefits of the program is that it permits the borrower to leverage its other sources of financing for a multiplier economic benefit, which is discussed in Part 2 of our detailed webinar. Moreover, there are softer foreclosure and enforcement rights if there is a default. A foreclosure can arise if the borrower defaults in making its below-market interest-only payments during the 7-year compliance period, or the borrower otherwise breaches the terms of its financing documents for whatever reason. In such a case, if any principal is paid back during the 7-year compliance period, the program requires that such principal be redeployed to another low-income community within 6 months. Thus, the investor and allocatee are motivated to work with the borrower in connection with any financial issues because the investor and the allocatee do not have any capital at risk. The investor has purchased the tax credits and doesn't expect a return of its purchase price, and the allocatee merely facilitates the financing without using any of its own funds. If applicable, state new market tax credits provide an additional subsidy. A state investor purchases these state new market tax credits in order to apply them against its state income taxes. Approximately 25% of states have their own state new market tax credit programs, which generally follow most of the legal and underwriting requirements of the federal new market tax credit program. And state investor may or may not be the same as the federal investor. Generally, state new market tax credits are provided in conjunction with federal new market tax credit financing. Often the new market tax credit financing provides the ability to obtain other financing, given that, as previously discussed, each of the forgiven loan and the non-forgiven loan is generally subordinated to other creditors. The forgiven loan is forgiven and therefore is viewed as a grant and not debt, and the non-forgiven loan has very low debt service payments compared to traditional financing because it can be amortized up to 40 years, which is well beyond any secured asset's useful life. Therefore, it is viewed as patient capital. Thus, creditors and equity providers are more likely to provide additional financing based on either form of program subsidy provided. And finally, the program results in substantial community and economic impacts to residents in low-income communities and targeted populations, including low-income persons, minorities, women, veterans, and other populations who have traditionally lacked access to capital, jobs, and vital community and consumer goods and services. Each of the following are good types of borrowers and projects for new market tax credit financing because they provide substantial community and economic impacts such as job creation and training, and provide community and consumer goods and services and other impacts to residents in low-income communities and targeted populations. These include those involving manufacturing, healthcare, grocery, education, qualified mixed use if the so-called 80-20 test is satisfied, which we'll discuss later, community facilities such as museums, cultural centers, libraries, youth centers, and community market venues, and renewable energy and recycling. New market tax credit financing may be used by any qualified business, and that includes both a for-profit and nonprofit, to acquire, construct, renovate, and expand bricks and mortar projects, including those related to healthcare, education, manufacturing, retail, qualified mixed use, cultural, community, and renewable energy and recycling projects, and also to finance business and nonprofit operations such as those in the nature described above, including the purchasing, refurbishing, retrofitting, or leasing of equipment, and/or funding working capital, inventory, and staffing. However, new market tax credit financing may not be used generally to refinance or prepay existing debt, but there are exceptions. For example, if debt is maturing and the borrower cannot otherwise refinance or pay it off, or the borrower is not able to timely pay its debt service payments, then new market tax credit financing may be able to be used, provided that the business or nonprofit would be partially or completely shutting down, resulting in significant direct or indirect job losses, losses of direct or indirect community or consumer goods and services, and or any other direct or indirect economic or other impacts in the community. New market tax credits also cannot be used to finance any so-called sin business, such as a gambling facility, racetrack, or business the principal activity of which is selling alcohol off premises. New market tax credit financing also cannot be used to participate in a transaction or series of transactions which is contrary to the intent of the program, such as that the borrower could have easily obtained traditional financing which is not overly burdensome. As previously discussed, new market tax credits are equal to 39% of the new market tax credit investment, which is known as a qualified equity investment. None of the borrower, its affiliates, or owners recognize the tax credits. An investor is typically a financial institution or a large corporation. It is important to note that an investor does not receive a direct or indirect ownership interest in the borrower or any of its affiliates. Instead, an investor receives a direct or indirect ownership interest in an affiliate of the allocatee, and it is this affiliate which directly provides the new market tax credit financing to the borrower. We will also discuss and illustrate the structure of a new market tax credit financing in part 2 of our webinar. An investor effectively purchases the tax credits based on current market pricing, desirability of participating in the particular financing, and if it is competing with other investors to participate in the financing. Therefore, it is important that borrowers generate as much interest among investors as possible in order to obtain the best pricing, which directly increases the benefits of the program subsidy to the borrower. We identify, profile, and solicit investors for best pricing and terms based on these 3 bullet points, and our goal is to generate as much competition among investors as possible. Each year, the CDFI fund provides non-monetary new market tax credit allocation authority awards to qualified community development entities, which are known as CDEs, after an extremely competitive process. A CDE has a primary mission of providing services for or providing investment capital for low-income communities or low-income persons. If a CDE receives an allocation award, it becomes an allocatee. This non-monetary allocation authority award authorizes an allocatee to designate a financing as being entitled to new market tax credits. Borrowers then have to compete to obtain one or more sub-allocations of allocation awards from one or more allocatees, which is also an extremely competitive process. Each allocatee has a service area, which is national, regional, multi-state, or local, and targets certain types of borrowers such as for-profits or nonprofits, certain types of projects such as healthcare or manufacturing, certain types of communities such as rural or metropolitan, certain uses of new market tax credit financing such as for real estate or non-real estate such as equipment, certain types of substantial community and economic impacts in its service area, such as job creation, green-related benefits, or providing healthcare, etc. In the case of the forgiven loan or the pool of non-forgiven loans, each allocatee spins off a separate CDE for each new market tax credit financing. In part 2 of our webinar, we will illustrate how this is facilitated in the IRS-approved leverage structure. We identify, profile, and solicit allocatees for maximum sub-allocation of their allocation awards, low fees, maximum forgiveness of the forgiven loan, other non-traditional and favorable terms, and optimal flexible underwriting criteria. We identify allocatees whose profiles, financing terms, service area, and underwriting requirements are the best fit for our borrower clients. We timely and strategically complete all intake forms of these allocatees, as well as provide required due diligence material and third-party supported community impacts and financial information. We are in an excellent position to negotiate term sheets provided by these allocatees because we are aware of current market conditions as well as having prior significant experience in negotiating with allocatees. There are many statutory and regulatory requirements, as well as specific guidance provided by the IRS and the CDFI fund, which apply to the program subsidy, whether in the form of the forgiven loan or the non-forgiven loan. We will discuss each of the following requirements. First, the project financed or the operations financed, as applicable, must be predominantly located in a low-income community or otherwise benefit targeted populations. There must be a gap in available financing, and the so-called but-for test must be satisfied. The borrower must be a qualified active low-income community business, which can include a nonprofit, and the borrower's trade or business or the nonprofit's purpose and operations must be a qualified business. The financing proceeds must be used for permitted uses and not for prohibited uses, as we previously discussed, and there cannot be a recapture event during the compliance period. The first legal requirement is that the borrower or the project finance must be predominantly located in a low-income community on the date of the funding of the financing. We can confirm that any particular borrower project address is located in a low-income community. However, please note that a low-income community is defined by U.S. Census data as a census tract with either a poverty rate of at least 20% or, depending on whether the census tract is located in a metropolitan or non-metropolitan area, satisfaction of the applicable 80% median family income test. This requirement must be satisfied on the date of the funding of the new market tax credit financing. If the census tract subsequently does not qualify as a low-income census tract, the requirement is still satisfied because the requirement must only be satisfied on the date of the funding of the new market tax credit financing, provided that the borrower's operations or the project as applicable remains in that census tract. However, a borrower's operations or project can be relocated during the compliance period as long as such relocation is to another low-income census tract and it receives the consent of the investor and the allocatee. This alternative test is rarely used. If a borrower or project is not predominantly located in a low-income community, it can be deemed to be in a low-income community if it otherwise benefits low-income persons as targeted populations throughout the compliance period. This targeted populations alternative test is satisfied if two requirements are satisfied. First, one of the following 3% tests must be satisfied during the compliance period. At least 50% of its total gross income is derived from sales, rentals, services, or other transactions with low-income persons, or at least 40% of its employees are low-income persons, or at least 50% of its owners are low-income persons. And second, depending on whether the census tract is located in a metropolitan or non-metropolitan area, satisfaction of the applicable 120% median family income test. The targeted populations alternative test is rarely used because tracking these percentage requirements to low-income persons can be tedious unless the borrower already has such a tracking system in place, which can be in the case with certain types of healthcare, charter schools, and Native American new market tax credit financings. Also, unlike the requirement to be predominantly located in a low-income community, which only has to be satisfied on the date of the funding of the new market tax credit financing, the targeted populations alternative test must be satisfied throughout the entire 7-year compliance period. If it is not, there is a recapture event, which results in 100% of the tax credits being recaptured and disallowed. Therefore, often these applicable percentages are increased as an underwriting matter by investors and allocatees in order to minimize the risk of a recapture event. A borrower must show that it cannot otherwise obtain a significant amount of financing. The but-for test is applied by one or more of the following. But for the new market tax credit financing, the overall financing will not proceed. The project or operations will be significantly reduced in scope. The project or operations will be substantially delayed. There will be unrealized substantial community and economic impacts, and/or the project or operations would not otherwise be predominantly located in a low-income community. With respect to the last bullet point, it must be shown that the new market tax credit financing will result in the borrower's proposed operations or project being located or relocated to a low-income community as a direct result of receiving the program subsidy as an incentive, when it otherwise would have been located or relocated to an area that is not a low-income community. The borrower must also be a qualified active low-income community business, which is known as a Qualic B. It must be a corporation, partnership, or limited liability company, or a division of any of the foregoing, which means having separate books and records relating to the new market tax credit financing, basically creating a division. The borrower also must have a trade or business, or in the case of a nonprofit, any activity that furthers its purpose, which is a qualified business, which we will discuss momentarily. Additionally, it must satisfy each of the following requirements during the term of the new market tax credit financing. These 5 requirements are to support that the borrower project is, quote, predominantly located in a low-income community. First, at least 50% of its total gross income must be derived from the active conduct of a qualified business within one or more low-income communities. Second, at least 40% of the use of its tangible property, whether owned or leased, must be within one or more low-income communities. Third, at least 40% of the services performed by its employees must be performed within one or more low-income communities. Note that employees don't have to reside in low-income communities or be low-income persons. The test is that the borrower's employees' services are performed in low-income communities. Also, these 3% tests are not applicable if the targeted alternative populations test is being used. However, as previously discussed, this alternative test is rarely used. Additionally, note that if the borrower cannot satisfy any of these requirements, there are alternative percentage tests. For example, if the borrower does not have any employees, then 85% rather than 40% of the use of the borrower's tangible personal property, whether owned or leased, must be located within one or more low-income communities. Additionally, during the term of the new market tax credit financing, regardless of whether the targeted population's alternative test is used or not, the borrower must satisfy each of these other 2 requirements. First, less than 5% of the average aggregate unadjusted bases of the borrower's property can be attributable to collectibles such as antiques, other than collectibles that are held primarily for the sale to customers in the ordinary course of business. This is effectively inventory. Second, less than 5% of the average of the aggregate unadjusted bases of the borrower's property can only be attributable to non-qualified financial property, such as holding cash or cash equivalents, owning debt, stock, and partnership interests. However, reasonable working capital and construction reserves are permitted above this threshold. The rationale of this non-qualified financial property test is that if there is substantial liquidity or revenue sources, the borrower is presumed to otherwise be able to use its own funds or otherwise have access to financing. Construction and working capital reserves are considered to be reasonable if they are reasonably expected to be expended within 12 months of the funding of the new market tax credit financing. If construction is anticipated to be longer than 12 months, there are ways in which to structure the financing to address this issue. If any of these 5% requirements to be a qualified active low-income community business cannot be initially satisfied, we assist the borrower to structure the organization to satisfy these 5% requirements. A qualified business includes any business that is not prohibited by the new market tax credit program. A qualified business includes manufacturing, healthcare, grocery, education, qualified mixed use if the so-called 80-20 test is satisfied, community facilities, and renewable energy and recycling. If the borrower is a for-profit business, it must be reasonably expected to generate revenues, as opposed to net income, which takes into account expenses, within 3 years of the funding of the financing. This must be illustrated in financial projections based on reasonable assumptions, and the debt service payments required by the new market tax credit financing must be shown to be able to be paid when due. We have experience in accounting, including previously practicing as certified public accountants, and have similar financial certifications. We work with our clients to provide such financial projection in the format and detail required by investors and allocatees. It is important to note that if revenues are not generated in 3 years, that does not result in the failure to be a qualified business or cause a recapture event, because the test is that it must be reasonably be determined to do so on the date of the funding of the new market tax credit financing based on reasonable assumptions. If the borrower is a nonprofit organization, it must be reasonably expected to engage in an activity that furthers one or more of its charitable purposes within 3 years of the funding of the financing. This reasonable expectation test does not require an expectation that revenues be generated within 3 years, as it is for a for-profit borrower. The nonprofit can actually operate at a projected or actual loss over the term of the new market tax credit financing, as long as it can show that its debt service payments will be made in a timely manner. As we discussed, we provide such financial projections. If it ultimately does not further such charitable purpose within 3 years, that does not result in the failure to be a qualified business or cause a recapture event, because this test also just has to be made based on reasonable assumptions at the time of the closing of the new market tax credit financing. A qualified business, however, does not include residential rental housing unless it is part of a qualified mixed-use project which satisfies the 80-20 test. This test requires that more than 20% of the revenue of the mixed-use project must come from non-residential rents, such as coming from rents from retail, commercial, and/or nonprofit tenants. This is a red line legal requirement which, if violated, can cause a recapture event. Therefore, as a practical underwriting matter, such percentage is generally required to be higher, such as up to 30% to 35%, to minimize the risk of a recapture event if a non-residential tenant is unable to pay its lease payments for whatever reason, such as going out of business or breaking its lease. If this percentage requirement still cannot be satisfied, we work with our clients to structure the new market tax credit financing and overall financing in order for such percentage requirement to be satisfied as it relates to the new market tax credit financing. A qualified business also does not include farming. A qualified business also does not include a business that consists predominantly of the development and holding of intangibles for the purpose of sale or licensing. However, this rule does not prohibit the borrower from developing its own intangibles, such as a patent, for its own use, such as a manufacturer developing an innovative new process. Additionally, a borrower can develop and hold intangibles for the purpose of sale or licensing, as long as that does not constitute more than 50% of its business activities. This satisfies the, quote, predominant standard. Finally, a qualified business does not include any of the following so-called sin businesses: a private or commercial golf course, a country club, a gambling facility, a racetrack, a hot tub facility, a suntan facility, a massage parlor, or any store the principal purpose of which is the sale of alcoholic beverages for consumption off premises. These prohibited businesses are similar to those prohibited by the federal tax-exempt bond rules. These are not the types of businesses that provide the desired community and economic impacts required by the new market tax credit program. If a borrower leases a new market tax credit finance project, no tenant may be a sin business as well, although the other types of businesses listed above may in fact be tenants. If any of these prohibitions are problematic in connection with the new market tax credit financing, we again work with our clients to structure the overall financing so that these requirements can be satisfied in connection with the new market tax credit financing. The 39% new market tax credits are recognized by the investor over the 7-year compliance period, 5% in each of the first 3 years, and 6% in the remaining 4 years. Unlike other tax credits, if there is a recapture event during the compliance period, 100% of the new market tax credits are recaptured from all prior years, which means that the investor must pay federal income taxes in the amount of such recaptured tax credits, plus penalties and interest, and disallowed for all remaining years of the compliance period. Thus, if there is a recapture event on the last day of the 7-year compliance period, 100% of the new market tax credits are recaptured. However, to date, there has never been a recapture event in connection with approximately $52 billion of new market tax credit financings because these transactions are carefully underwritten and monitored, and there are cure periods to remedy certain recapture events depending on the facts and circumstances. Given that there has never been a recapture event, we will not discuss them in detail in this webinar, although they are set forth in the following 2 slides. As we discussed, each year, qualified community development entities known as CDEs apply to the CDFI fund for an allocation award, which is an extremely competitive process. Once a CDE receives an allocation award, it becomes an allocatee. To be competitive, each potential allocatee generally commits to satisfy certain high benchmarks in order to demonstrate that the intent of the new market tax credit program will be maximized over and above the minimum standards required by the CDFI fund, such as targeted and specific types of community and economic impacts and expeditious deployment of its allocation award to borrowers and projects. Such high benchmarks result in an allocatee having high underwriting standards related to borrowers and projects. Therefore, obtaining a sub-allocation of part of an allocatee's allocation award is also very competitive. Although new market tax credit financing provides flexible underwriting criteria in connection with the financial terms, it is subject to high underwriting standards in connection with the community and economic impacts in the low-income community and to its residents and other targeted populations. Accordingly, the project and/or operations of the business or nonprofit should satisfy several underwriting requirements, which apply whether the new market tax credit program subsidies in the form of the forgiven loan or the non-forgiven loan, including but not limited to the following: being shovel ready. Allocatees want to be able to deploy their allocation awards faster than the statutory minimum requirement of 5 years, and the majority of allocatees generally commit to deploying their allocation awards within 1 to 1.5 years. And if they do so, then their track record for doing so results in their applications for allocation awards scoring higher in later years. Additionally, and as momentarily discussed, the borrower project should be predominantly located in not only a low-income community, but also one that is highly distressed. A borrower should also demonstrate that it will provide or retain substantial community and economic impacts to residents in low-income communities and targeted populations such as low-income persons, minorities, women, and veterans. There should also be strong local support. On behalf of our clients, based on the particular requirements of investors and allocatees, we provide an objective third-party confirmation of local support, including interviews with local officials and community stakeholders, and provide a persuasive and detailed narrative that the new market tax credit financing will facilitate a true public-private partnership, including any indirect investment in the community based on our impact analysis. And often it is beneficial to be located in a so-called underserved state, which can include in alphabetical order Florida, Georgia, Idaho, Kansas, Nevada, Tennessee, Texas, West Virginia, and Wyoming. These underserved states are those which have not benefited from new market tax credit financing compared to other states in the past few years for whatever reason. Therefore, some allocatees are targeting such states for new market tax credit financing, either because they have committed to do so to the CDFI fund or in order to score higher on their subsequent allocation applications submitted to the CDFI fund. To be shovel ready, a borrower must show that all other sources of financing are otherwise committed or close to being committed. All other conditions are satisfied or close to being satisfied, such as having site control, zoning approvals, permits, and good title. If the borrower is a for-profit, revenues, as opposed to net income, are reasonably expected to be generated within 3 years. If the borrower is a nonprofit organization, one or more of its charitable purposes are reasonably expected to be furthered within 3 years, and substantial community and economic impacts will be timely achieved. However, it is important to note that once a shortfall in financing is determined, or a shortfall could arise, it is critical to get on the radar screens of allocatees who are looking for specific types of borrowers and projects, as well as types and locations of communities in which they are located. This requirement can vary from year to year and even within a year. We identify, profile, and solicit potential allocatees in order to provide them with notice of such shortfall, in order for them to highlight the borrower project in their annual applications for allocation awards to the CDFI fund, or at a minimum become part of their pipeline of potential financings. We provide a detailed and strategic executive summary, including support of the satisfaction of all legal, tax, and underwriting requirements. If an allocatee receives an allocation award and the borrower is shovel-ready, the borrower is more likely to receive a commitment letter from such allocatee to participate in the new market tax credit financing of the borrower or the project. New market tax credit financing is much more likely to be provided to a borrower project which is located in a highly distressed low-income community, which includes a census tract that is either one of 4 primary distress criteria or 2 of several secondary distress criteria. Primary distress criteria include a poverty rate of at least 30% compared to the statutory minimum of 20%, or being located in a rural community. The other 2 primary distress criteria include unemployment rates that are 1.5 times the national average, or having median family income below 60% compared to the statutory minimum of 80%. Alternatively, if at least 2 of several secondary distress criteria characterize the low-income community, the community is also highly distressed. For example, if the poverty rate is at least 25% compared to the statutory minimum of 20%, or satisfying any of several other secondary criteria, such as being located in an enterprise zone or otherwise designated as distressed by any federal, regional, state, or local agency. Some of these secondary distress criteria only apply to certain types of borrowers and projects. For example, if the borrower is a grocery store, a secondary criteria would include that it is located in a food desert. And if a borrower is a healthcare facility, a secondary criteria would include if it's in a medically underserved area. However, a manufacturing facility that's located in a food desert or a medically underserved area does not get to count these distress criteria for purposes of this second test. The more highly distressed, specifically the more primary and secondary criteria that characterize the low-income community, the more likely an allocatee and investor will be interested in participating in the new market tax credit financing with the borrower. In fact, all allocatees that have received allocation awards from the last annual round have committed to provide at least 75% of their allocation awards to highly distressed low-income communities or low-income census tracts with very high unemployment rates. A borrower must qualitatively and quantitatively provide support of substantial community and economic impact to residents of low-income communities in which the borrower or project is located, surrounding communities, and targeted populations, including low-income persons, minorities, women, and veterans. They must also execute a community benefits agreement. The community and economic impacts include any of the following: direct and indirect full-time and part-time job creation, job retention, and construction jobs, especially if accessible to low-income persons and other targeted populations, jobs that provide living wages, healthcare benefits, retirement plans, life insurance, job training, and continuing education, consumer and/or community goods and services. If the project is leased, the tenants provide their own community and economic impacts, and the borrower provides below market lease rates or favorable terms to nonprofit and minority-owned and women-owned tenants. Set-asides for affordable housing if it's part of a mixed-use project. Typically, the investor and allocatee prefer a set-aside for low-income persons and other targeted populations and require rent restrictions. However, if the rental housing is not a significant part of the mixed-use project, or the retail, commercial, and nonprofit tenants provide substantial community and economic impacts, such set-asides for affordable housing may not be required to such a degree or not required at all. Another community impact includes green type benefits such as satisfying LEED standards, and any other community benefits such as the renovation of historic properties or reducing blight. Borrowers are required to execute a community benefits agreement, pursuant to which they are required to use, quote, commercially reasonable efforts so that its projected community and economic impacts are realized during the 7-year compliance period. As we discussed, each of the following are good types of borrowers and projects for the program subsidy because they generally provide significant community and economic impact and have strong local support. First, manufacturing facilities are good candidates because they generally recreate a significant amount of jobs and provide job training. Healthcare facilities, especially if they're located in a medically underserved area, because they provide critical health and urgent care services. Grocery stores, especially if they are located in a food desert, because they provide critical access to food, including healthy foods. Charter and independent schools, especially if the students are targeted populations or children of targeted populations. Qualified mixed-use projects, because they often provide set-aside units for low-income persons with rent restrictions, and the retail, commercial, and nonprofit tenants provide important consumer and community goods and services. Community-based services, such as those provided by museums, cultural centers, libraries, youth centers, and community market venues because they are cultural, educational, and benefit targeted populations. And renewable energy and recycling because they provide green-related impacts. It is important to note that the community and economic impacts are not mutually exclusive, so specific borrowers and projects. For example, a manufacturing facility can provide job creation, but also satisfy LEED standards, provide daycare to its employees' children, or healthy foods to its employees. The more community and economic impacts, the more likely a borrower will receive new market tax credit financing. New market tax credit financing, which is known as the qualified equity investment, is equal to the sum of the investor's purchase price for the tax credits and the leverage sources, which include the borrower's other sources of financing, which can include other debt and equity sources, and federal and state and local subsidies, and 2 years of prior expenditures to the extent that they are primarily capitalizable and depreciable. New market tax credit financing may be only part of an overall larger financing. Generally, in order to receive the forgiven loan, there must be a shortfall in available financing of at least approximately $1.5 million, and the leverage sources must be at least approximately $4.5 million. Generally, the non-forgiven loan and the new market tax credit financing each must be below approximately $2 million. We will discuss the overall sizing and structuring of new market tax credit financing in part 2 of this webinar. We won't repeat the following benefits of new market tax credit financing to borrowers, but will momentarily pause for your brief review. Applying to investors, allocatees, and other new market tax credit financing participants is extremely competitive, even for a borrower that will use the new market tax credit financing to provide various substantial community and economic impacts in a highly distressed low-income community. As we discussed, our fees are contingent upon the securing of new market tax credit financing on behalf of our clients. We have profiled all allocatees and investors and have developed our intake form, which incorporates each allocatee's and each investor's intake form questions, which vary among investors and allocatees. This permits us to timely and strategically complete our targeted allocatees and investors intake forms in an efficient, timely, and strategic way. We are able to use our continually updated profiles of Allocatees investors to persuasively respond to their intake form questions and obtain and provide required due diligence materials in order to support that our borrower clients satisfy our targeted Allocatees and investors' particular underwriting requirements. These requirements may or may not be reflected in their intake forms. However, we are aware of any non-published underwriting criteria based on our prior experience with these Allocatees and investors and continual dialogue with them. We also have significant experience in writing grants and reviewing grant applications on behalf of the CDFI fund, including applications submitted by potential Allocatees each year. This provides us with a background that permits us to provide a persuasive and cohesive narrative which is supported by necessary and critical analysis of our borrower clients' particular facts and circumstances in connection with submitting new market tax credit financing applications to Allocatees and borrowers. Upon engagement, we will provide our client with our comprehensive intake form, answer our client's questions in connection with completing such form, answer many of the questions ourselves based on our research to support that the structure of the overall financing satisfies legal, tax, underwriting, and structuring requirements, including that all of the Allocatees, investors, and leveraged lenders' unique underwriting requirements will be satisfied. Leveraged lenders are either the sources of the borrower's other financing or financing which we have identified and secured on behalf of the borrower. We will discuss leveraged lenders in detail in part 2 of our webinar. Additionally, we will identify all applicable primary and secondary distress characteristics of the census tract and properly document them. We will qualify and quantify direct and indirect community and economic impacts based on third-party or industry standard modeling. We will independently confirm that there is strong local support. If applicable, we will confirm and document that there will be or could be catalytic subsequent economic and community development as a result of the new market tax credit financing. Confirm that such other relevant facts and circumstances are supported and documented, and manage the overall financing from start to finish. We will identify and solicit Allocatees for maximum sub-allocation of their new market tax credit allocation awards, maximum forgiveness of the forgiven loan, optimal economic terms, optimal flexible financial underwriting criteria, and low sub-allocation fees. We also identify and solicit investors for optimal new market tax credit pricing. The higher the price, the higher the program subsidy that is provided to the borrower. Other optimal financing terms and optimal flexible financial underwriting criteria. We will also identify and solicit leverage lenders to the extent that our client has not identified leverage lenders for the amount of leverage funds needed or its 2 years of prior capital expenditures for optimal interest rate, other optimal financial terms, and optimal flexible financial underwriting criteria. Again, we quarterback each new market tax credit financing from start to finish, and our fees are contingent upon our securing such financing on behalf of our clients. If you have any questions regarding this presentation, please email us or click on the green tab entitled Contact Initial Intake Form, which is located at the top right side of our main website page. Additionally, please note upon request, we provide live webinars targeted towards specific industries and borrowers during which participants may ask questions. These webinars are at no cost. Again, thank you for taking the time to participate in this webinar, and this now concludes part 1 of our webinar.